We're good to kind of co-host this together, kind of meshing it together. I do definitely want to introduce Brad and Simon into this conversation a little bit. I did change the title as well, long-term investing and general market analysis. I'm definitely down to talk kind of what we were talking there, what's happening right now. We have CPI tomorrow, which I know will definitely be a big thing. Stock talk, I would love to ask a couple questions around that and a couple other numbers you're looking. And we can still do the general talking around and maybe ask some questions from the crowd. But I do want to give the floor to Simon and Brad to introduce themselves, kind of see what they're thinking about the market right now and anything from the long term perspective. I would love to start it out with Simon, though. First of all, introduce yourself. I'd love to hear a little bit about what Seven Investing is there, and then yeah, just kind of how you're feeling about the market. Anything you're kind of thinking long term that you want to start with, and we'll go from there.
Yeah, sounds good. Evan, thanks very much for having me. The company that I'm representing is Seven Investing. Our mission is to empower people to become better long-term investors. Our business, our product is a subscription that gives you access to each of our 7 advisors' very best idea in the stock market every month. So times 7, we have 7 that we issue every month. We package up into a subscription product. We talk about it over time. It's very interactive, a lot of fun to talk about the greatest ideas that we have in the stock market. And a lot of the times, even though we look a lot at fundamentals and kind of company-specific things, we also like to chat about what we see going on in the bigger picture too. And for this conversation, in terms of the general market analysis, I think that one of the things that I've been looking at a lot that is going to be very pertinent for this is the moves that Jerome Powell is taking in raising the fund rate so aggressively to try to curtail inflation that I'm certain several other guests have been chatting about for the last hour or so. Is certainly aggressive, and it led to the yield curve inversion on April 1st. And this is one that gets talked about a lot because it kind of carries like this negative connotation, right? We don't talk about Bruno, we don't talk about the yield curve inversion. It's because the last 4 times that we've had an inversion like this, it's led to a U.S. recession. I heard the previous speaker actually just chatting about the recession. We've only had 4 times in the last 35 years that you have had the 2-year treasury paying a higher rate than the 10-year treasury. And that's what the inversion means. It means that short-term rates are going up so significantly and so quickly because the Fed is taking actions to curtail inflation. But the interesting piece to me, it's actually predictive of a U.S. recession in the last 4 instances. U.S. recession defined, of course, of negative GDP for 2 consecutive quarters. But as a long-term investor, the interesting piece is that these indicators are out there, they're public. Jerome Powell has been talking about this for 6 months, and we've seen the flight to safety from institutional funds. We have seen a mass migration of herd mentality, if you will, from large growth funds to large value and large blend funds. And these are hundreds of billions of dollars, right? $200 billion moving into blend and 100 billion moving out of growth over the last 12 months. So this isn't exactly a surprise. And the reason I bring all this up as a long-term investor is I just think it's a fantastic time to be starting a position for anyone who's got money that's available right now. In those past 4 inversions, they've averaged an average of 17 months, just about 17 months, almost a year and a half between the point of the inversion and the worst of the U.S. recession. But over that same time frame, the S&P 500 index, the largest companies in America, have averaged a 29% return in the stock market. Total shareholder return of the S&P 500 has been almost 29% over a year and a half, which is, of course, very, very strong. And those are the largest companies. I think that several companies in the NASDAQ, several of the tech companies, are going to bounce back even stronger from this. So we might be seeing, it's not unrealistic to say we're going to see 40, 50% gains in tech stocks that have strong fundamental growth in their business that is out of touch with kind of the valuation multiples contracting, as we've seen just the dynamics of the market, the flight to safety, large funds pulling money out. It's very, very hard to swim upstream when things like that are going on. And so back to kind of full circle, Evan, as we're talking about long-term investing and what this means, what I'm looking for is, guidance is very conservative. No company wants to stick their neck out there and be wrong right now. That has punished a lot of companies on the day of their earnings announcements. But on the other hand, still, when you're seeing a lot of these growing revenue at 40, 50% or more than that, I think there's some long-term developing trends that I'm certainly very aware of. The digital transformation is certainly one of those right now that's very interesting to me. The semiconductor industry and the chip shortage right now is another one that's very, very interesting, but still very, very strong fundamentals in cloud computing and the chips that are required in those data centers to provide for it. So altogether, I think it's certainly a tough time for the American economy. I think it's almost very, very, very likely in my mind that we're going to be seeing a recession here. But also there's some very, very bullish indicators for the stock market. And that's where I have my eyes and my attention.
What are the bullish indicators you're seeing, Simon, if you don't mind me asking?
Yeah, I mean, like like the S&P 500 index itself, in times of the inversion, it's the interest rates and everything we just discussed about. I look less closely at CPI numbers and whether Jerome is actually going to get inflation down to 2%. I don't think a soft landing is like that. I think this is going to be a much more challenging task for the Fed than it's perhaps being portrayed right now. But on the other hand, when you see companies growing at 40% that are cloud native, that have fantastic margins, and they're selling at 8 times sales, that's out of sync. That's a company whose valuation multiple is out of sync with the growth rates that we're seeing. And I just chatted last week with somebody who their business is deploying new IT solutions for large enterprise, rather the S&P 50 or 100 largest companies out there, and they're not really seeing a slowdown. They're seeing conservative guidance, but when it comes to deploying IT tech stacks and the infrastructure required to support cloud computing, this is really not slowing down just because of the movement of funds. And so it's those kind of dislocations. For me, as a fundamental focused growth style investor that I claim to be, I like the setup that is looking at a lot of stocks right now.
Interesting. Yeah. And for those that I know you touched on the recession profile from the last 35 years. I pinned a post at the top of the nest for those that are interested in looking at some historical data. It just is covering the data of the last 13 rate hike cycles and how quickly we got to a recession. So the shortest period from the beginning of a rate hike cycle to recession in the last, since 1946, was the 93 rate hike cycle, which took 10 months, and the 1980 rate hike cycle, which took 10 months as well. If we print a recession in July, that'll be 5 months from the first rate hike to recession, if I'm not mistaken. Anybody remember when the first hike was? Yeah. Because that'll be twice as fast as ever, which is interesting.
I am seeing March 16th is when they first started raising rates. But awesome. In general,
maybe one final comment on this. As somebody your Boston Consulting Group has done some excellent empirical research on what drives stock market returns. Why do stocks go up over long periods of time? And especially one of the studies that I always liked was the Value Creators Index. They publish it publicly. I can post it to my Twitter if anyone is interested in reading the actual report, but it finds the correlations of the stock market's best performing companies, right? So like, who are the companies of, the Netflixes of the world, or, the Amazons, who are the best performers? Shopify was on the list. Who are the best performers over 10-year periods? Not in a year or two, not in something that's going to be extremely exposed to inflation or volatility in commodities and supply chains. But like, if you're going to find the best performing stocks, which is I think what we're all trying to do, or at least my organization, trying to find the best of the best, and look at what is the highest correlated factor to the stock returns that they post over a decade, right? What is it that's really driving this? The answer is not super surprising. It's profitable revenue growth. It's between 50 to 70% between total shareholder return and revenue growth of these companies. And you say, okay, well, yeah, Simon, that's obvious. You want to find a company that can grow, but how can you find a company that's having profitable revenue growth for a decade? It's a lot harder than it sounds. And I think that even in the short term, you're going to see a lot of ups and downs. You're going to see people saying whether a price to sales ratio of 10 is reasonable this year, or if it's 40 this year is reasonable. I mean, look at Upstart as a perfect example of this. I think Upstart's price to sales ratio has been between 42 and something like 8 or 7 recently. Market has no idea what it wants to value the revenue growth of this company, which is triple digits, even though it's facing the headwinds right now. But you look at kind of longer periods of time, and a lot of that just kind of fades away. The market is going to do what it's going to do in 2022, just like it did what it's going to do in 2021. but there's nothing that says you have to back the truck up at any given moment of time and say, okay, I'm all in because I think this is the bottom, or, I'm all out because this is at the top. A lot of investing gains are finding great companies, adding to them over long periods of time, and letting the market step back and appreciate, the profitable businesses they're creating, the revenue growth that they're displaying.
Awesome. Thank you, Simon. And in general, I'm totally down for these free-flowing type of things. If any of the other speakers want to come in, ask questions, comments off of whatever, totally feel free. Best spaces are the ones that are free-flowing and kind of interactive in there. So definitely more than okay with that. If we want to continue with that, Mr. Steak Talk. And and to everyone else up here, Knocker, Gavin, Sim, I think you got to comment on that other account you were on last night, the burner. Maybe it will fit a little bit more, but showing off the group. Shout out to that. But Brad, I want to bring you back into it for the first time. Would love to hear a little bit, same thing there, and how you're feeling about the market, how you're feeling about some of the stocks, any news stories or anything standing out. Just kind of generally, floor is yours.
Yeah, pretty slow week, I guess, but not really a slow week. I mean, I have 11 investor conferences from companies that I hold where it's just basically listening to a CFO or a CEO tell me that everything is still status quo and looking good or not. So nothing super interesting to report. I mean, the most interesting thing from this week I thought was that like the Rick or the spaces yesterday between the Bulls and the Bears of Rick, or I think it's called that. And that was just, I mean, that was explosive and really, really entertaining to listen to. But somebody or Sniper has their hand up, so I'm going to pass the mic to her.
No, I'm just gonna be trimming some of these Tesla contracts, 35%. I'm holding runners still, break even stop loss. Sorry about that. Go ahead.
No worries at all. Yeah. So for me, the also in that long term investing camp, I think the macroeconomic discussion right now is really warranted and well placed, because I think that's just what's dominantly driving the movements that we're seeing in stocks and in multiples. So I kind of think of it as like, I'm sure a lot of people on this panel watch Stranger Things, and like the upside down and good is bad and bad is good, and that's sort of where we find ourselves right now. So we have really kind of, I mean, Snapchat reporting macroeconomic pain is not really a bellwether for the rest of markets, but what is a target profit warning 3 weeks after its report, or Tesla or PayPal laying off some workers, or Walmart and also Target gluts, or Amazon limiting their capacity. I mean, these are bellwethers for economic growth and economic health, and these are all signs that cracks are forming, and that's, I mean, that sucks for the economy, but for these long duration growth stocks that I own, that is what we need to happen. I mean, we need credit spreads to look a lot scarier. We need growth to slow down, and we need the CPI print to start coming in core CPI as well, in order for us to get to that dovish pivot we're looking for, which I don't think we're all that close to, but these are signs at least that we're, sorry, the laundry machine song is on in the background, but these are signs at least that we're sort of kind of getting there. I mean, rate hikes are going to continue to come. I think it's all but guaranteed that we're going to get 50 basis points in the next 2 meetings, and we're even getting talks now of that continuing on into September. I mean, passive QT is only going to really beginning in 6 days, so we haven't even started that yet. So all that's just to say that we're getting there. We're getting the economic weakening and the demand equilibrium, or supply and demand equilibrium, that we're really all looking for, to finally hopefully get to a point where we don't have to be hiking rates 50 basis points every single week, but we're not there yet. And so for me, what that means is just continuing to slowly add, but continuing to make sure that the cash infusions into my account are bigger than the additions that I'm making, so that the cash position's building. And that'll turn when we continue to get green shoots. Skirg, I hear you, but I'm going to finish up real quick. When we continue to get green shoots, like the Atlanta, or not Atlanta, that was pretty scary, but here I had a data point that I wanted to share, with places like the Atlanta Fed, Philadelphia Fed, New York Fed, and the Beige Book that we got last week, all showing signs of forward inflation expectations continuing to come down, not to 2%, but closer to 2%, and a whole lot further away from 8%, and all reporting price moderations or price pressure moderations that are really welcome and really needed right now. So all that's going to happen, all that's going to continue to play out. It's probably going to, I mean, it's not to sound overly dramatic, but it's probably not going to be a fun time for growth stock investors for at least the next few quarters, or I don't want to put a time frame on it. I'm just going to wait for the data to continue to coming in and to continue to see when this peak hawkishness, not when I think it's going to stop, but when it can stop, when we get things like the CPI falling well below 8%, and hopefully 3 or 4 months in a row of stable declines. I mean, that's really what we need to see, and that's really what we should be singularly focused on right now, with the labor market as strong as it is at this point in time, even with all these layoff and hiring slowdown signs that we're getting. The labor market still is very strong, and the Federal Reserve does have two mandates, and that is labor and that is inflation. So with one strong and the other looking extremely intimidating, they should be wholeheartedly focused on that. And they're going to continue to be, which I mean, when you're sucking money out of the economy, when you're making cost of capital more expensive for everybody, when you're making future cash flows discounted far more heavily, I mean, that's not a sign to just be two thumbs up and like Simon was saying, it's not a time to be going all in and just, okay, all clear, green light, good to go. And for me, that's manifesting itself in my cash position being towards the high end of that band that I use of 5 to 25%. It's I think it changes, or I was rounding up a couple hours ago, and now it might be time to round down, but it's either 22.2 or 21.2 or 21.3% cash. I'm not a huge difference, but want to be accurate. That's really all I have to say. We got the George Kurtz feisty quotes about CrowdStrike versus SentinelOne yesterday that I'll put in the News of the Week post, but really no groundbreaking news for the holdings I'm in to report. Just really focused on the economy and macro land, which I don't really like to be focused on. I'm a stock picker, and I like to be focused on picking stocks, but with as intimidating and as dynamic as macro land is right now, that's what's being focused on, and rightfully so. So I'm kind of forced to focus there, and will adapt accordingly.
Right, you can always leverage those stock analysis skills of yours on the short side as well.
Yeah, I probably should. Like last year or
Because one
18
thing I
months
know
ago.
about you, or sorry, I don't mean to interrupt you. One thing I know about you is that you are very apt when it comes to fundamental analysis. But I think that you sometimes, and a lot of other investors sometimes, kind of feel that inherent long bias. But I think in climates like this, where you're seeing such rapid multiple compression, I definitely personally believe you have the wherewithal to identify companies that are probably good shorts. You know what I mean? Especially considering that there's a lot of companies now in this climate that are getting huge share unlocks or investor unlocks and are really vulnerable. Those kind of events help accelerate the road to reality, if you will. A lot of these D-SPACs that have absurd valuations. I mean, the second they get an unlock, it's like the valuation gets corrected in 2 or 3 sessions. Some of those moves can be really profitable. I mean, look at FRGE today. It's down 32% now. It could drop more, especially if SPY drops more. We had EMBK a couple weeks ago, Embark Trucks. It was like a zero revenue company, was worth a couple billion on D-SPAC. That fell 60% in one day. So like having puts on these or going short on these, just because they're absurd zero revenue companies with multi-billion-dollar valuations, it's something I definitely feel like you could find a lot of profit in, Brad, personally.
I'm definitely in the same camp there, honestly. Something that I haven't really tried enough. Stock Talk, I would love to kind of ask you, for someone in my situation in that area, like,
Can
where
I
do you kind of
respond,
start with that? Yeah, go for it, Brad. All you.
Yeah, I think for me, for me personally, it's just really a matter of staying in my lane and doing what's really comfortable for me, and that could, to a certain degree, breed complacency, and I think that's sort of what you're getting at. But at the same time, I don't think right now is the time for me to deviate from a path or a plan, and to use the capital that I'm preserving for hopefully allocating into the long names. And I do clearly have a long bias, and it's a very strong long bias. But I think just staying in my lane and doing what I know best and is very familiar to me. I think with as hectic as all these exogenous factors that we've highlighted are, I think it's just that's best for me right now, not to try to change up the game plan or change things up. But clearly, I mean, you've demonstrated, a lot of other people on this panel have demonstrated, there are so many good ways to create alpha in markets. And at the end of the day, I mean, that's really what we're all chasing. So definitely for other people who are kind of who do have the emotional makeup and maybe yeah, I think emotional makeup is a good way to frame it, to be more kind of moving and shaking in short term and long short. I think this is a phenomenal environment for you. But I mean, for me, my character, the way, not character. I'm not trying to say better or worse, because it's not better or worse. It's different. But the way I'm wired, it just works better for me to be that long term only, using cash to hedge. I think that works really well for me. I mean, I've dabbled in options in the past, and it hasn't gone well. And I think it's long term investing in long only is a way for me to kind of minimize and diminish the weaknesses in kind of my makeup, and kind of highlight the strengths in my makeup. So certainly respect that there are so many great other ways to do this, and obviously Stake Talk Weekly, not Stock Talk Weekly. You've clearly demonstrated that, but appreciate your thoughts, and now we'll pass it over to Ev.
Question for you. So how do you protect your stocks long term if you don't sell like covered calls or anything? Do you buy like the inverse of something? Do
I
you buy
do.
like
So I do
stock
pretty
in like
actively. So
SQQQ or something?
Yep. So I'll answer your question now. So I do pretty actively trim positions and add to positions. So the reason I do have that elevated cash position is because when things get out of hand, and you can, I mean, if you go to advanced search on Twitter and type in my account and trim or trimming, you'll see all the messages pop up about when companies do get really ahead of their shoes. I am actively trimming 5 to 10% of a position, which, I mean, in 2021, 5 to 10% of a position was like 50% of my cost basis. So that's really how I manage cash and ensure I have liquidity and flexibility and the opportunity to take advantage of future opportunities. So that is how I do things. And obviously covered calls and all that is another way to do things.
Awesome. Appreciate
Oh,
that. I think I'm gonna take it back and kind of move us off of Brad. I feel like we've been on like 15 minutes and him. I'll let us slide it off a little bit, but definitely love hearing Brad a lot more. Very, very smart guy. He puts out a newsletter on all of his stocks. That's free each and every single weekend on Saturday. So definitely check the link in his bio on that for a lot of really comprehensive coverage on a lot of the stock that he does. But Stock Talk, I do want to throw it over to you. Honestly, I know you're a long-term investor as well. I know you like to play both sides of it. Would love to hear, first of all, honestly, your thoughts on someone, and kind of from me, who hasn't really played that short downside a little bit, the long-term investor, where kind of you would start out. Is it looking at, like you said, those de-SPACs with obvious kind of things in your mind there, in general, and then just, any other thoughts you have from long-term perspective, or whatever you got.
Yeah, look, in my perspective, and I definitely respect what Brad said about doing what you're comfortable with. I think, especially when you're using real money, you definitely should do what you're comfortable with. But as always, I've done this with you, Evan. I've done this with Brad. I think all of my colleagues and friends who I try to encourage, even TSDR, who, I think before he met me, he really only was purely a price action day trader. I just think that learning how to trade different mechanisms in the market, different perspectives, long, short, whether you're doing it with going outright short on equities or whether you're doing it with puts or whatever it may be. I just think these things are just useful. At the end of the day, I'm of the belief that everyone's a trader. The only thing that changes is your time frame. Because, even long-term investors like you and Brad, right? You guys are long-term period investors, and that's a great way to do it. It's probably the most common way that investors and traders become successful is by investing long term, because at the end of the day, over the very long term, stocks go up. So I don't think there's anything wrong with that. But I'm of the belief that we're all traders, because eventually even investors sell their stocks, right? If you bought Amazon when it's $100, you probably sold it somewhere on the way to $3,000. Same thing if you bought Apple, years ago. You probably sold it somewhere along the way, or maybe you didn't. Maybe you didn't. But at some point, you probably will, or your kids will. And so, I think there's value in investing. I've owned Tesla for, almost 6 years now. I've owned LTHM for almost 3 years now. There are stocks that along the way I'll invest in for what I think is a reasonable amount of time. But I don't think that, the way I always phrase this is, I don't think that labeling yourself as an investor is a good excuse for poor capital management. Because at the end of the day, we're all in this for one purpose. And obviously I'm speaking outside of people who invest for social purposes or to further a cause. I'm not speaking about those types of investments. Those types of investments are great, and I'm not discouraging people from doing those. But I think for the most part, people who are trading and investing in the market have one goal, which is return on investment, right? You want the stocks that you buy to go up, and you want the stocks you short to go down. Knowing that your goal is return on investment, in my opinion, people should always be looking for the best way to allocate their capital, whether that's rotating, whether that's reassessing your position and asking yourself, one simple step I always encourage people to take, and I think this applies to traders and investors alike. You should regularly review your positions and ask yourself, would I buy more of this? At this price, would I buy more of this? If your answer is no, then your position management of that stock, regardless of your conviction, in my opinion, shouldn't be defensive, because that's what a lot of investors do. They look at a stock, and I think there are certain exceptions. If there's a stock that you have, I would say a very specific exception is if there's a stock that you've owned for a long time and you have a very favorable cost basis, and even though the stock's down substantially, it's still, hundreds or thousands of percent above your cost basis. That's an exception to this. But if that's not the case, if you're up a little bit or even worse, down on the position, and you look at it in the environment of the market, because you can't look at stocks in a vacuum and ask yourself this question, because that's not the way multiples work, right? Like multiple compression, when it starts happening, happens broadly. And that's what we saw happen over the course of the last, 6 to 8 months. It happens quickly. It's an elevator down. And so sitting through that as an investor, I do not think is a testament to your resilience, because most investors can redeploy their capital. Yeah, there's things like tax implications, but if you're an investor and you've had the position for over a year, you're going to pay long-term capital gains on it anyway. But even if you're not going to sell those positions, I think not acting, knowing that they're going to go down, right? In my opinion, if you had asked most investors in December and January,
But you don't know they're going to go down.
No. This is what I'm about to say. If you had asked most investors in December or January, what do you think is going to happen in most stocks when the rate hike cycle starts? What do you think most investors would have said? They're probably going to go down. We're probably going to see multiple compression. We may see a recession, like the pinned post above, where we saw it 10 to 13 times. So if everyone saw this coming, my question is, why didn't enough people act defensively? And that's really, I think, the crux of it, because to me, that is poor capital allocation. And to me, it doesn't matter whether you're an investor or a trader. It's just nonsensical, because you're not acting at something that you even personally believe is going to happen. And yeah, every time everybody thinks the market's going to go down, does it? No. But historically speaking, every time the Fed wants the market to go down, it goes down. And every time the Fed wants the market to go up, it goes up. And so we all saw this. This was broadcasted, right? But people, I know personally, I know people whose portfolios are down like 60, 70% year to date. I don't think there's an excuse for that. I don't think being an investor is an excuse for that. I think that's either an inability to rotate, because there's sectors that have been strong this year. The commodities have been strong, energy has been strong, agriculture has been strong. There's been hot sectors on a monthly basis where you could have found strength. There have been long opportunities. There have been plenty of short opportunities. If you're hedged appropriately, then you could have stayed market neutral this entire time as well, or you could have been net cash and you could have been relatively market neutral that way. But I think if anybody who's down massively year to date, if you're down a little bit year to date, yeah, a lot of people are. The S&P's down a little bit year to date. But if you're massively underperforming the indexes this year, in my opinion, to me, that is probably a result of inaction. It's probably a result of the bystander mentality that so many investors have. And this isn't me talking shit to Brad or you, Evan, or anybody specifically. This is, to me, I genuinely think it's a bug in the investor community because of the labeling, Like, I just think it's this mentality of like, oh, I can't do anything to play the downside, or I can't do anything to expose myself to the downside. If you're going to be net long exposed in climates like this, I feel like you have to find either a hedge or you have to find a way to play short exposure, whether it's on individual equities or the broader market. That's just my view on it. And again, I don't do it perfectly, but I find a lot of comfort in trying to make those maneuvers, even if they aren't always successful, because when they are successful, you feel like you really did, act to preserve your capital or act to, seize opportunity, because there's been plenty of opportunities. It's just been the other direction. Whether you shorted RK, whether you shorted the Qs, whether you shorted an individual stock that had zero revenues and a 50 billion market cap, whatever it was, I feel like there were obvious shorts, there were obvious macroeconomic headwinds, and people who didn't do anything about it or didn't try to gain any exposure, even if it was on the long side with energy. I just don't understand that personally. And I don't think that that's a knock on those people. I just think it should be a lesson so that in future environments where everything is so macroeconomically dictated, that people realize, hey, I have to, you have to play along with the Fed. They're the most powerful economic organization in the world by far, and you have to play along to their tune, as much as it sucks to do it. And honestly, the perfect top was when they all got out of the stock market and there was that huge conflict of interest. I don't know if anybody's ever seen that. It was literally like 3 days away from the top. You can't fight them. They are the market. The Fed is the market. When everything was going up, it was for that reason, and when everything is going down, it's because of them as well.
Could I chime in with some thoughts about that?
I was actually coming right to you, Simon.
It's some great points. I'm not going to. I like the perspective that you bring up, and we all have different perspectives. We're all approaching the stock market in different ways, right? There's nothing that says that every investor has to do the same thing or have the same approach or perspective. Like, that's kind of what makes the market, is there's two sides to every trade. From a personal anecdote, though, I've seen maybe a different perspective from that, which encourages being a bit more patient and thinking a bit longer term as an investor. It's a very different game when you want to be a kind of a shorter term trader, especially if you're going short on positions or using options for short positions. That can blow up even the most quantitative hedge funds out there that have got these sophisticated models, using a lot more data than we have as retail investors. Even they blow up all the time when they're going short, and then all of a sudden AMC or GameStop blows up the plan that they had for it. And nobody would have seen that one coming because they thought, oh, there's no catalyst for these kinds of companies. But the particular anecdote that I'd like to share is actually with relation to Tesla, right? I don't want to say blanket coverage about all the companies in the market or everything works the way that it certainly does. But Tesla was one that I got exposure to actually through Solar City back in 2013. I bought right after the IPO, found this innovative company, said that I was going to hold on to it for years. And it wasn't more than a few years later than that Solar City got acquired by Tesla. A huge controversy about this, first and foremost. And then it wasn't even very far after that people were questioning whether Tesla as a company was going to go bankrupt. Specifically 2016, I had conversations with CFA charter holders, people that have really, really gotten behind the curtain and looked at the nitty gritty. A lot of data, a lot of indicators, a lot of information saying, hey, Elon's about to go bust, Tesla is done. And he was very convincing in the arguments that he made that I should go short Tesla in 2016. The company was about to go to zero. And I don't think I need to tell anybody on this call that Tesla has done phenomenally well. It's now the fourth largest company in the S&P by market cap. Over the 6 years from 2016, it's about a 16 times the market cap it had just 6 years ago. At the time that, everyone was saying kind of a lot of the similar things about, there's liquidity concerns, there's balance sheet concerns, there's just a variety of reasons. And I guess that my only sentiment on this, and I of course I respect every perspective on the stock market because we all make each other smarter every time we have these conversations. But there's a good reason why I have chosen to be a long-term investor. And it's not in buy and hold and pray, just hope for the best and, ignore the data. I mean, Brad will back me up on this too, that even a long-term investor can be talked out of a position if things are turning against them. But it's also, in my opinion, much, much harder for retail investors to take short positions in the algorithmic trading world that we are today, where there's 90% of the trading that's being done by bots that are quantitative. I mean, if we want to play that game and try to beat those algorithms, that's much, much harder than trying to identify a competitive advantage in a company that's getting stronger over time. So maybe just my 2 cents, Evan. I appreciate, the panelists that spoke up about this, but from my perspective, it's very, very hard to actually execute efficiently if you're trying to short the market or go against the market as a whole.
I don't think he's saying you have to short the market, but instead of like owning Tesla and watching it fall down to like $500 and lose half its value and losing all that and hoping it goes back up, you could buy covered calls and make, profit each week off of your calls and that offset your losses from the stock. And I think if you don't do that, it's not very wise.
No, I mean, I don't think, again,
Hey, Ev, I'm gonna hop off, but everybody have a wonderful day, and enjoy this as always. Have a great day, everyone.
Take care, Brad.
Appreciate you coming on, Brad.
yeah, I don't think
Stock
you have
tuckers in.
short or go puts. I think there's other ways you can do it, like rotating. Like I think people who wanted to be long, if they were long on commodities, they would have done great, right? So I don't think you have to go outright short with, unlimited downside. That's not what I'm advocating, especially for new traders. I'm just saying there are ways to play the downside that you can do that are more responsible. And there's also ways that you can play the upside just in different sectors than you typically would. I mean, if you had just sat through long growth in tech, then it probably didn't go as well as if you had gone long in some of these other commodities, whether it was lithium, oil, any of these agricultural stocks that have all done well, fertilizer stocks that have done well. I hear what you're saying as well, Simon, and I do think there's different strategies, but I think that like being able to be flexible and adapt as the market is changing prevents those huge drawdowns, I think, or at least can help mitigate them, that a lot of new investors have taken. I mean, being down 60 or 70%, in a few months of the year, that to me is probably because of inaction, like I said, more than anything.
Yeah, I respect that. I certainly respect different approaches to the market. I didn't want to make it clear that, one way is right or one way is wrong. There's definitely plenty of room for a bunch of different approaches. I just wanted to share a perspective from a long-term investor.
I do definitely think a big thing is we're talking different ways to outperform the market over a period of time. For the average person with no time to put in and just want to make money, you're not going to come in here and try and play that downside. You're not going to come in here and pick individual stocks for the upside. The best thing you do is buy those broad-based indexes. Maybe I think, Stock Talk will come in here and say you look at those macro conditions. You maybe change when you're buying, but at the end of the day, it's buy and hold those broad-based ETFs, and more or less the stock market goes up over time, not those individual stocks. But we're kind of talking in that niche in there of how do I outperform that over time, and there definitely are a lot of different styles in there. So love having a discussion about it. But Simon, I saw you unmuted there.
It's so interesting. I think the bigger picture, Evan, of kind of the state of the market, or the mood of the market. We always kind of it was a year ago, right? If everyone remembers where we were a year ago, where everyone's kind of paying millions of dollars for NFTs of Bored Apes, right? And you've got these tech companies that are just raising money at whatever valuation they want to for a SPAC. And everyone's refinancing their home, right? Because interest rates are super low. People are retiring early. Like, it's like the worst news that was out there was like these ships getting stuck sideways in the Suez Canal. It's like, optimism was like reigning the financial media headlines. And it's so interesting now to like see the complete opposite, right? Of course, a lot's happened. The reason I bring this up is it felt like if you were reading the headlines at that time, that everything could go right and nothing could go wrong. And in my opinion, it's 180 degrees different today. It feels like everything is wrong and pessimism reigns. And, we've got to go into cash and, store beef jerky and ammunition underneath our bed at night now because the market is this lurking monster that's going to destroy fortunes. And certainly nobody, I can't disagree that, anyone who bought last year in the middle of the optimism has certainly felt a lot of pain over 12 months. There's no doubt about that. I'm just saying that, that is a more challenging time to buy when stocks are selling at 40 times sales or 50 times sales. And it seems retrospective that we look back on it and say, oh, the market is so bad. It's just so painful to watch it. To me, it's the complete opposite. You want to actually buy and be greedy when others are fearful, rather than fearful when others are greedy. It's not hope and pray. It's just kind of, there are better opportunities to be mindful of that are out of touch with, I think, the bigger picture about the Fed and the negativity in the American economy and the recession. I personally think right now is a much better time to be buying than 12 months ago. And of course, hindsight's always 20/20 for everyone, but it's very interesting to see the different tone being presented in the financial media that I'm at least seeing today.
I agree completely with that. And I think you also, it's a step further. Analysts do the same things. They change the price target after the stock falls. They drop it, or after it's up a lot, they raise it after, It's hard to find an individual stock. And in 2020, 2021, mostly 2020, it was rewarded pretty much anything. And now those opportunities in there's a lot of those stocks that are down 70%, 80%. Can they fall more? Yeah. Are most of them probably going to keep going down? Yeah. But are there some gems in there that will recover and will make long-term investors in there who kind of was able to pick that and kind of, invest in that and hold it? Will it make them a lot of money? Yeah. So I agree with you very much there, Simon, that, for those companies that you're laser focused on, that, you're not even going to get 100% of them. If you're shooting for 10Xs, you can do your work on a lot of stocks. You hit 2 out of 10 and you're rich with 10Xs. And you can even make that even more by cutting your losses at less than 100%. So there's a lot of great stuff there. And I definitely do appreciate this conversation from both ends. Before I throw it over to Sim and bring her into this a little bit more again, Simon's, I just said, I was going to say steak talk, so I had to stop myself there for a little bit. Was there anything you guys want to add in here? Any more extra topics?
Yeah, knowledge is power, right? Like, use information to your advantage. Reddit's founder, Steve Hussman, was chatting at a conference I was at not too long ago. And I actually kind of think this is a neat movement of empowering people with information. The Wall Street's bet, the AMC and the GameStop stuff, people can say a lot of things that they want to about that, but net, more information that people are bringing out, whether it's, in this Twitter Spaces, which you are always so generous to invite me to, Evan, and different perspectives from different investors, whether we're playing the long game or the short game or the long-term game or the short-term game. I mean, information is meant to be empowering to people to make decisions off. We're all personally making decisions in the stock market. I don't ever shy away from more information as a net benefit rather than less information and us being ignorant about what's going on out there. So I encourage these. I enjoy these conversations. I really appreciate different perspectives, and I've always appreciated you having me on these spaces.
Definitely love having you on these spaces, Simon. Very, very smart guy. You could tell through speaking. We can have these open discussions and kind of go into it. So definitely a regular on these spaces. Got to get you on a couple more than these long-term investing. Maybe we get you on some chill ones, or maybe some of your stocks when they come up on earnings. You could join some of our live earning spaces. But I think that would all be fantastic. Major shout out to 7 Investing as well. If you want to know what that is, and you want more Simon, check the link in his bio. But Sim, I want to bring you into this. And I kind of have a question for you. Maybe this is niche, maybe this is whatever, but as a trader in the market who is doing really good in there, or killing it, do you have a long-term investing account? Do you think that's something important to you at all in there? And it could be as far as just holding the indexes in there, or could be a little bit more advanced picking stocks. But yeah, we'd love to hear your kind of perspective about what you're doing for the long term there with those trades, or is it kind of just cost benefit now? You're kind of just throwing it all into trades. It has been a while, maybe a little unfair to just over to Sim. Perfect. All right, no worries there. Maybe if you try steak.
Nope.
Didn't work. Rip. All right, no worries at all. Wolf. I want to throw it back to you, Mr. Bullish. Rippers. Actually, we don't have the Wolf account up here. There's no verified accounts up here. It doesn't happen that much in the Wolf spaces anymore.
My phone decided to start an update.
Ooh, rip. But yeah, we'd love to hear your kind of thoughts, anything you want to add here, kind of how you're playing for the long term. And then maybe if we wanted to kind of start off into wrap-ups a little bit, maybe we talk some more of the spaces we got coming a little bit today.
Yeah, sure. For the long term, I haven't really added. I'm excited to start adding some of these positions for the long term. There's definitely a number of stocks, and shout out to Investing for some great ideas that I really want to start adding to, but I've just been waiting here. I just haven't added to a long position this year. I mean, the only one that I did was wheat, and that eventually got stopped out. So, nothing else has been added to this year by me, which is, interesting. It's been a little bit, but not for the worst to see that happening. I think that there's some stuff, especially like, Meta, I was looking at, at these levels, like there's just a lot of companies that I still believe have some pretty strong futures and are starting to, not fall, it seems, as hard as they were in the past. Meta, I think Nvidia is another one where there's a lot of times where I looked at Nvidia and said, hey, it comes back down to X level, I'm going to add, right? And, Nvidia under 200 was something which I was kind of waiting for a long time. And now we have that opportunity. So I think there's a number here, but what I'm waiting for again, and we talked about this on the Space with the Street yesterday, I think SPY is going to come back down to 384 again. I think it's going to retest that anchor view up from the COVID lows before we were able to go elsewhere. And I also, as everybody's talked about, I want to see what the macro data says tomorrow. I really want to see this print next month with the GDP. And just kind of like let some of the pieces fall before I go ahead and add. So excited to add. I think it's, a really interesting opportunity that so many stocks did come down so hard so fast, and I don't want to miss that on the upside. But just waiting a little bit here. As for the spaces for the rest of the day, we have a 3 p.m. space. That's going to be the next one. That's going to be a power hour with Brian Shannon and Richard Moglin. Then right after that, we have a 4 p.m. or 3:50 earnings space. This is the only earnings space we're doing this week, and it is because we have DocuSign today. So it'll probably be about 5-10 minutes talking about actual earnings and just maybe like 20 minutes talking about the week in the market. So you can come for some market chatter then and a little bit of earnings. And then at 4:30 p.m., I'm going to be doing a space called Film in Web3. I was reached out to by some pretty significant players in the Web3 space. Should be a good one having them on. At 5:30, we're going to be discussing the NFT legal landscape. So really just the legal side of everything, how to navigate that. 6:30 p.m., doing some more project highlights. 7:30 p.m., we're going to be talking about real estate in Web3 with Balcony DAO. And 8:30 p.m., going to be doing another crypto chat with Hodlnaut. A lot of people have been really interested. I mean, the whole staking thing has been one of the most consistent pieces. Right now, I think USDC, the rates are still at 9.4% APY. I think this can move down slightly next month to somewhere around 7 to 8%, but still, it's some pretty nice money to be making on weekly payouts. So those are the rest of the day. That's 1, 2, 3, 4, 5, 6, 7 more spaces that'll be coming up today. So a nice, healthy handful of those, and then another slate of spaces tomorrow. So that's what I got going on, Evan.
Awesome, Wolf. Appreciate that, and looking forward to it. Definitely great to have you on these spaces. Massive shout out to the Bullish Rippers account for hosting this for the last, we went live at 10:30, so more than 2 hours. We have been live, putting out this all awesome free content. All we ask that you follow the amazing account up here that's hosting it, Simon, Sim, and then Stock Talk. Are we trying to grow the Stake Talk account at all? Do we care about it, or are we what are we doing?
I mean, I don't care. People can follow it if they want to follow it. I'll post pictures of steak sometimes.
If you like meat, follow Steak Talk. So big meat guy down there. I'm going to throw it over to you, you, Mr. Meat. We'd love to hear what you're watching for the rest of the week. Anything you got in wrap-ups, and then maybe we have the spaces tomorrow, right, on Fridays. 11
We
a.m.
do have
Eastern?
that tomorrow. Yeah. So yeah, that'll be at 10 a.m. Central, 11 a.m. Eastern. Not on the Steak Talk Weekly account, but on my main account on Stock Talk Weekly. Yeah, that'll be fun. And we also, me and Jay, Evan, what are you doing after hours?
Today or tomorrow?
Today.
I don't think really anything. I know I got one.
Do you have anything after hours, Wolf?
I do. I have literally we have the brief earnings space we're going to do for DocuSign, and then I'll be on spaces directly. So I'm going to open a space at 3 p.m. and I'm not going to close it till 9:30.
Oh, yeah, because me and Jay are doing a space on the housing market at 3:15.
Oh, all right. Well, that's when we're going to be doing, we typically do a power hour with Brian Shannon and Richard Moglin.
That's right he's talking, that's Central, so it'll be 4:15 our time, I think.
Okay. Yeah. So we'll be finishing up our, what do you call it? Our, probably our
live earnings. Yeah, going into maybe one of your crypto
then.
spaces.
Yeah, and then I'll be going into some crypto and other stuff after that. I'm gonna do a real estate one at 7:30. Maybe if you guys want to pop in with some of those insights from your real estate space.
Yeah, or if you want to reschedule that real estate space and move it up, if those speakers can make it, you can push integrate it with.
Unfortunately, so I have a 3 p.m. and then a 3:15.
Oh, you have one overlapping with ours?
I have a 4:30, then a 5:30, then a 6:30, then a 7:30, then an 8:30 today. So they're all back to back, and they all have like 7 speakers scheduled, and they've all been scheduled for a week.
All right. Well, well, Evan, if you're free, if you want to jump on that, feel free. That'll be at 3:15 Central, so 4:15 Eastern.
Yeah, man. I'm sure it'll be good regardless. There's definitely plenty of different crowds on here that are always looking for spaces.
Sounds good.
Cool, Evan. Anything else for this one?
Oh, I forgot. I didn't realize I was unmuted there. But yeah, definitely need to throw it over to Simon. I'd love to hear some of his thoughts there. Anything else in wrap ups? And also, would love to hear a little bit more about 7 investing too, Simon.
Yeah, thanks, guys. One that's really on my radar and I've been paying a lot of attention to, especially in my own 7 investing recommendations recently, has been the semiconductor industry. I just think that, when you see the cloud service providers growing 30, 40%, that's, the Amazons and the Microsofts and the Googles of the world. And then all the applications are kind of being built more efficiently from this whole DevOps movement. You got to have the hardware that keeps up with the software that demands all of that. And there are a handful of companies that are really in the right position to capitalize on this. Chip shortage isn't going away anytime soon. Capacity is catching up with demand out there. Good opportunity for long-term investors who want to get into chip stocks.
Evan, you there? Oh, he declined. Okay. I think he's.
Wolf, I think I scared him away. It must have been something I said.
Yeah. He must be having some technical difficulties. All right, Simon, great having you on. Really enjoyed the conversation as always. Anything else you want to add on?
No, always a pleasure. Thank you very much for having me.
Okay, cool. Appreciate everybody who tuned in. This was great. I think we're pretty much going to wrap up here. We ran for about 2.5 hours. I'll just give final comments here to Evan, and then we'll close out.
Yeah, Payne, that wasn't even a disconnect or me going to another account. I just full on got booted there. But massive shout out to all the amazing speakers on the spaces. Make sure you're following each and every single one of them. Simon, Sim, Stake Talk up here, fantastic accounts, fantastic follows. Make sure you're following Wolf Financial as well. He's hosting 40 hours of live spaces every single week, and Bullish Rippers for bringing us all together in those last 2.5 hours. A lot of fantastic free content coming out of them. So major shout out to that. Meta put out a tweet about Meta scaling back their AR glasses according to the information, but we'll see going forward. And yeah, appreciate it, Wolf.
Awesome. Sounds good, everybody. Take care. Enjoy the rest of your days. We'll